Thank you very much, everybody. Welcome back. Pardon me for the furry voice there. Welcome back to the afternoon session of the Consumer Advisory Board meeting. This morning we heard from a number of Bureau offices about new research and observations about the marketplace. This afternoon we're going to hear from CAB members themselves about their views about opportunities and challenges in the consumer marketplace, specifically with respect to small business lending and reverse mortgages. Following that, we will hear from Bureau staff about its recently released request for information on small business lending markets, and we'll engage the CAB to get their feedback on the request for information. But to kick us off, we have CAB members Paulina Gonzalez, who's the Executive Director of the California Reinvestment Coalition, and Lynn Drysdale, who is an attorney, managing attorney for the Consumer Law Unit for Jacksonville Area Legal Aid in Florida. So first, we will have Paulina. Thank you so much.
Good afternoon. Hi, everybody. So I'm with the California Reinvestment Coalition, and we're in California, as it says in our name. We're a coalition of 300 organizational members representing CDFIs, small business technical assistance providers, financial counselors, legal service providers, and housing counselors who work in low-income communities and communities of color in California. Our mission is to ensure that financial institutions and other corporations reinvest in the communities that our members work in, and that they provide affordable and equitable financial services in low-income communities and communities of color. Now, I just realized I don't know how to change the slides as I was talking. Is that this? Yeah. Okay, great. So I'm going to take us through some slides I've prepared on small business lending. We're very excited to be able to talk about this both on data nationally and in California. Many of our members are working with small businesses in California, and we're especially excited about 1071, the rule that the CFPB is beginning work on, and we were at the hearing in Los Angeles. We want to thank the director and the staff that attended that hearing. Our members were there to present on their experiences in the communities, and we're very excited about the research that's been released, the white paper. And so, as you all know and you've heard today, 1071's purpose is to facilitate enforcement of fair lending laws and enable communities, governmental entities, and creditors to identify business and community development needs and opportunities of women-owned, minority-owned, and small businesses. And this is a photo of Teresa Garcia from Meta, one of our members in the mission in San Francisco. So just taking a look, and as Grady had just mentioned and has mentioned throughout when we're talking about small business data, there is no one source. So we have to pull it together from many different sources. So I'm going to talk about some of the data that we find to be really important. And I do want to say that for us, one of our board members has said this time and time again to not only staff at CRC, but to the CFPB, that data is policy. That data will always drive policy. It was true for HMDA, and it'll be true for 1071. And without data and without the transparency of it, it's very difficult to not only know what is happening in the small business lending field, but also to be able to ensure that we're able to be clear about who is getting the loans in small business and who isn't. But of the data that we do have, and Woodstock Institute, one of our partners who we work really closely with, has put together a report and found that of CRA reportable loans in 2014, that lending went down by 60% from the peak in 2007 for small business lending, and the dollar amount went down by 37%. So 2007 being the time of the beginning of the financial crisis, and the number of CRA reportable loans under $100,000. So these are loans that we think are extremely important because they help, especially the smallest of the small businesses, drop 61% lower than in 2007, and the dollar amount decreased by 52%. This graph was also in that same report by Woodstock, and I know the CFPB has a similar graph in their report. One thing that I want to point out about this data, so you see the rise from 2002 to the peak right before the financial crisis in small business lending. Again, this is CRA reportable loans. So these are loans. When we're talking about CRA reportable loans in small business, we're talking about loans that are less than $1 million. So they can be up to $1 million, the loans themselves. What happens in 2008 is you see the steep decline, and you see this both in dollars and the number of loans. And we often hear that regulation is a deterrent to lending. I do want to point out that at the time of the creation of the CFPB, around the time of 2011, you actually start to see an incremental rise in lending and small business. So I think that's a really important point to those that seek to attack the role of the CFPB. And we're not back to the pre-crisis levels, but we are starting to see a rise in lending. So thinking about low-income census tracts between 2012 and 2014. So if we take a look at national small business lending, we talked about CRA reportable loans. And again, this is Woodstock's report. They looked at low-income census tracts, and they compromised. So businesses in these tracts between 2012 and 2014 comprised an average of 9.3% of all businesses. But they received only 4.7% of total amounts of CRA reportable loans under $100,000. Again, these loans being very important for business expansion, startups. And one thing I want to point out in terms of the CFPB's current report that they released, the white paper on small businesses, and the director also referred to this in his remarks this morning, was that counties with a higher percent of their workforce employed by small businesses exhibit positive trends with respect to local incomes. Right? So if we're talking about in low-income census tracts, there being a difficulty in obtaining loans for small businesses, and especially loans in under $100,000, what kind of impact does that have on the local economy of these low-income census tracts? So there's we pulled some data also from the federal. If you haven't seen the credit survey done by the Federal Reserve on small businesses, you should take a look at that. It came out this year, and look at because they actually surveyed small businesses themselves and asked them about their experience in actually trying to obtain small business loans. And came back with some very interesting information. So we know that for businesses with under $1 million in annual revenue, it's especially challenging to obtain bank loans. And we also know, we learned from the CFPB's white paper, that 97.7% of all minority and owned and 98.3% of women-owned businesses were under $1 million in annual revenue. And something I learned yesterday when we were talking to the staff of the CFPB is that actually for all small businesses, it's above 90%. If we look at all small businesses that are in the 90% range of under $1 million in annual revenue. But it's much higher for minority and women-owned small businesses. But the 60% of smaller businesses, and I'm talking about businesses with less than $1 million in revenue, obtain less than the amount that they actually sought in small business financing. So you need more than, if you need a loan for $1 million and you're only able to get a loan for $200,000, right? So you're not getting the full amount, or you need a loan for $500,000, you're only able to get some portion of that. If you have a revenue of more than $1 million a year, 45% of larger firms were not able to get the full amount sought, and that is true across credit risk categories. We've been talking a lot about credit cards, and one thing that I want us to think about when thinking about credit cards is that it's one aspect of small business financing, but banks are moving more and more to credit cards and away from other types of small business lending. And what the Small Business Credit Survey that the Federal Reserve conducted found was that 86% of credit applicants sought another source of credit for their business, and only 31% applied for a credit card for small business loans. Or for a small business, for their small business. We don't have anything against credit cards. We think, it's one aspect of small business financing, but they are more expensive. We want to know how many of those small businesses are moving from credit cards into other types of loans with that financial institution. And it's not information we currently have access to, and it's important information to have. And credit cards are not useful for small businesses to be able to buy, equipment purchases, for instance, and or expand their businesses. And they're currently not covered by TILA or the CARD Act. So it's something that's extremely challenging. And we're getting a lot of feedback that from small businesses that banks are not offering other types of loans and maybe pushing people into credit cards. And so that's something that can be extremely concerning. And so in California, we have some data. And so this came from the CRA Wiz 2015 small business data that we collected. If we looked at the top small business data by market share, 46.7% of it was in credit card lending. So American Express, 30% of the market share. This is a number of loans. Chase Bank, 10%, and we know Chase Bank, of their small business lending, 95% of it is credit card lending. We know that because they told us that. Capital One at 6.7%, and we have no other information related to bank credit card lending on the rest of the banks listed on that data because that data doesn't exist. And it's important information to have because of what I said earlier in terms of the cost of credit card lending for business owners and what types of lending are other banks doing by bank. We also saw Synchrony on that list, and we know Synchrony is one of the credit card lenders. And we also knew they do deferred lending. We also know from data that we collected through our survey in California that two of the large national banks reported to us that they do 30% of their small business lending is credit card lending, and one of the large national banks reported that only 3% of their small business lending is credit card lending. So we know it's possible to limit the credit card lending and offer other types of products to small businesses if the bank chooses to do so. And then the other point is that credit card lending in dollar amounts was at least 17% of market share. So each credit card usage is a loan, but the amounts are small, right? So you may be using the credit card, high usage rates, but the amounts are not very big. You're not able to use it for $100,000, right? And so there's questions about are small businesses getting stuck with credit cards for loans? And then are banks offering a variety of small business lending products to meet a need? Or does the credit card usage reflect a demand? Does it reflect demand or supply? So what do small businesses need? Or is it that banks are only offering this as the supply versus what the demand is in small business lending? So there's definitely a need, and who's filling the gap? In terms of alternative lenders, the California Department of Business Oversight did a study, a survey actually, and found in terms of online lenders, right, we know the ease of applications. It takes 30 minutes to get a decision or to fill it out, and you can get a decision within hours instead of days or weeks, and that this is hard for banks to compete with who don't have this type of platform. And we saw that between 2010 and 2014, financing transactions grew in California for these online lenders by 629%. And so this was a self-selection. So the companies that responded to the survey self-selected. I think there were something like 12 to 14 companies that responded. And they found the DBO found that the APR was somewhere between 74% and dropped to 51% in 2015. And then, so you're seeing a huge growth in these online lenders, these alternative lenders. Opportunity Fund, one of our members, did a study of merchant cash advance loans. This study was done of their refis, so people that are coming in, small business owners that are coming into their to their organization, to their CDFI, to get refinanced. They found the average APR to be 94%, and an average monthly loan payments were nearly double the net income, 178% of it, that was available to the owners. So huge, average monthly loan payments. And among Latino borrowers in the sample, the average monthly payment was more than 400% of their take-home pay. So there was a disparity among Latino borrowers in their sample. This was a tour we did in the Mission with the director and Grady. Was it last year? So we were very grateful to be able to do that tour. That was a small business owner that accompanied. You were dressed. The Federal Reserve allowed us to use these slides, and I think this paints a very interesting picture of the type of lending that's happening and who's doing the lending. So if you look at, we talked again about those businesses that have less than $1 million in revenue a year and those that have more than $1 million, and what the percentages are that fall in those ranges. And CDFIs, we talked about CDFIs that do meet a need. And I want to say this is an ecosystem, right? To meet the need of small business lending in our communities, it really does take an ecosystem. We're going to need the CDFIs. We're going to need small banks. And we're going to need the large banks. We're going to need the credit unions. And we are going to need some responsible online lenders. But if they're not responsible or we're not having large banks make loans, we have a problem. That's when we get into the, unscrupulous online lenders who start to meet this need. And so here you see the under $1 million revenue and the over $1 million revenue. CDFIs are actually making loans in both of those spaces. Small banks are actually doing pretty well in both of those spaces, and online lenders are actually making more loans in the over $1 million revenue space than in the under, but they're rivaling the small banks, and they're third among the under $1 million revenue. But if you look at the large banks are making less than the CDFIs when they're ranked here, right? So and they're not quite meeting the need. But if you look at the over $1 million revenue, they're actually rivaling, and I think they're at 72% there. They're rivaling towards the top in the over $1 million range. So they're not really, making the loans to the under $1 million revenue range. This is my favorite graph. It's a little funny, but it actually makes a really interesting point. So if you talk about application rate, approval rates, and then satisfaction, right? So this is the Federal Reserve again. If you look at CDFIs, this is application rate. So of the sample, how many people applied to CDFIs? What was their approval rate? 77%. And then their satisfaction, CDFIs are doing really well. And then if you look at, let's look at small banks, 46% application rate, approval rate 67%, satisfaction rate 75%. But you look at the online lenders, their application rate is 21%. So if the sample 21% applied, their approval rate is 62%. So a high approval rate, but the satisfaction rate drops to 26%. Right. And then you look at the large banks, and their application rate is 50%, approval rate 54%, and the satisfaction rate at 47%. So it tells us something about the online lender rate. It tells us something about the approval rates, and then small banks do really well as well in terms of their satisfaction rates.
Paulina?
Yes.
Is it okay if we ask you questions?
Sure.
You want us to hold until the end?
I think I don't know how much I have left, but yes, we can ask questions. I think the next is just about women and minority-owned businesses. If you want, I don't have that much left. If I go through it really quick, and I can come back to some slides. I'll try to go through this really quick. So, through the SBA, I want to just make this point around the SBA. The only data we have on race and ethnicity and gender data around small business lending is the data collected by the SBA. And one bank, Union Bank, actually, has a exemption to Reg B, and they collect the data, although they don't they don't report it necessarily out publicly. But so women are half as likely as men to obtain business loans. And just in 2016, just 18% of SBA 7A and 17% of 504 loans went to women-owned businesses. If you look at bank loans for people of color-owned businesses, so these are businesses with 51% ownership by women or people of color. Bank loans are at half the rate for Latino, African American, than non-minority, right? And business cards are at around the same rate. SBA lending by race, and this is dollar amounts. You again see by race through the SBA data for 2016, a huge disparity. So you see white borrowers with 62%. This is national data. And then Asian Pacific Islanders at 13%. There's an undetermined category, so I'm assuming these are people who did not mark a category. And then Latino at 8, Black at 3.5, and American Indian at 0.6, less than 1%. California is similar. I'm sorry, the colors are different. I couldn't figure out how to get these colors to be better colors, but it's a very similar category. And in California, the white borrowers were at 44%, Asian or Pacific Islander at 26%, Latino at 13%, Black at 2%, less than the national, and American Indian at 0.49. So this is my last slide on recommendations. ECOA enforcement is extremely important for banks and non-bank lenders. So I'm talking about the alternative lenders here. UDAP, to apply to non-bank lenders would be an extremely important, to be able to have that kind of authority. A complaint process, both for ECOA and other types of complaints. Right now, the FTC website has a website for small businesses. It's not. It's about how. It's not. You can't file a complaint there. And I know with the CFPB, there is an other category, but trying to figure that out. And the authority I know is not. With the COA it's there, but it's unclear with the others. The 1071 data, like I said, we're so excited about that moving forward, and want to support the Bureau in that. The loan sizes for banks, to have that information, we negotiated as part of CRA plans. One of the benchmarks we have and the bank's CRA plans that we've negotiated is that 50% of CRA qualified loans either be to small businesses with revenue under $1 million, or 50% to loans under $150,000. So small loans to smaller sized businesses. And also for banks to have referral programs that if they decline loans, that they refer those to CDFIs and community lenders who might be able to make those loans. The banks should support CDFIs and community lenders and TA providers through philanthropy who can work with small businesses to help them become credit ready to be able to move to bank lending. That banks participate in federal and state guarantee programs like California's State Loan Guarantee Program, which guarantee loans and are able to reach some of the communities that are currently underserved. And consumer protections applying to small business credit cards who act as consumers in the marketplace. So I'll stop there. Thanks.
Thank you so much. Already the hands shoot up. Thanks for your presentation, Paulina. Sure. It was a dead heat, but I think I saw Lisa, then Chi-Chi. And
for that research. A couple things I wanted to raise. one that I thought of yesterday, but there wasn't really time to talk about it, which is that I've always been troubled. I've done a lot of work in the past on micro businesses. And, this category of small business is 500 employees or less. And there is such a huge difference between a sole proprietorship and a 500-person business. And the data that we got yesterday actually showed that nearly half of all of the businesses that are labeled small are sole proprietorships. So it's just a plea for really differentiating that segment. I think it's super important because people want different things out of those businesses. They're not even always interested in growing, different needs, et cetera. The other thing I wanted to say is that, we're talking about CDFIs, which I think can do a really good job in this space. But that field is so incredibly fragmented. And I think in the work that I've done, there's even an underuse of loan funds among many smaller, lower capacity providers. And so I think, again, there's kind of a spectrum of more efficient small business lenders in the CDFI space and those that are maybe doing more TA, not really having a hard time getting the loans out of the door or spending $4 to lend $1. And so I think that's a piece of it that we need to tease out a little bit more. The final thing I would say is that there seems to be an education component that's necessary for some of these small businesses because the CDFIs don't necessarily, they definitely don't have the advertising budget that the other online lenders do. And so, and their process is obviously longer. And so I think a lot of small business owners don't even know about the existence of a good CDFIs who are making lower cost loans and maybe even providing the kind of TA that will enable that business to stay in business longer. And so I don't know if that's something where could be some public sector involvement. It's to get the word out about good CDFIs that are making these loans.
I thought her slides documented that pretty convincingly, that there was such a small percentage of applications to CDFIs. So,
yeah, I mean, there are 50 organizations in New York City that do some form of, and most of them nobody's ever heard of, and it's incredibly fragmented. So you have everybody counting data, you have everybody trying to manage a loan fund, and I've always thought there should be a lot more synthesis and synergy, but that's not happening.
I would say that the CDFIs and other community lenders, which is I think it's like I said, an ecosystem. Technical assistance providers are absolutely a need and are part of that ecosystem in order to to get part of that outreach to make sure small business owners are getting connected. But the other piece is that without the banks who have much broader outreach, who have the resources not only to do the philanthropy for the technical assistance. We have some CRA plans that have technical assistance pools as much as $500,000 a year, for one bank. Now, that's one bank, in California. Is it enough? Not close. So what are other banks doing, in that space? And there are banks who are doing it. But what about the lending? The graph on the lending piece for banks is that they're not meeting that need. And so CDFIs can't do it by themselves. And then you have, the move to online lenders and or alternative lenders or merchant cash advance. And so agreed. And it is that ecosystem, and part of that ecosystem right now is missing.
Very quick follow-up. There's also kind of a gap, I think, between micro lender CDFIs going up to $35,000 or $50,000, and banks don't want to touch anything below about $100,000. So nobody's doing that space in between.
Great. Chi-Chi and then Judy.
I'm hoping I can use this microphone. Yes, no feedback. So I'm glad I actually went after you, Lisa, because I wanted to sort of play off your point about distinguishing between, the small businesses that are actually a lot bigger and the large chunk of small businesses that are actually sole proprietors, or, what the Grady was saying yesterday when they think of themselves as self-employed, or somebody was saying that they think of themselves as self-employed, and also dovetailing with this issue of consumer protections applying to small businesses. I mean, interestingly, some of the federal consumer laws, their definition of consumer is individual. It's not necessarily tied to family, household, personal use, such as FCRA, and then we know the ECOA covers some business credit. And the tough one is the Truth in Lending Act, because the Truth in Lending Act clearly it ties credit to family, household, or personal use. But even there, Dodd-Frank did add to the CFPB's authority in terms of interpreting TILA the ability to add additional requirements. And when you have an individual who gets a business card, it's based on their personal credit report and personal credit score. It's reported on their personal credit report. They're liable if something happens. I mean, that person is basically a consumer, and yet they don't have any of the Card Act protections, such as ability to pay and no retroactive rate increases.
Thank you. Judy, then Seema.
So I actually want to echo a lot of what Lisa said. I don't get involved in this world on purpose. I get involved in this world by accident when people come in collections, and typically they didn't even realize it was a business loan, right? They call themselves self-employed. In fact, they're small businesses. They got a credit card, not realizing it was a commercial card. And so I really think we do need to tease out those differences. And something we were talking about actually last night made me think of it is even to the extent when people are filing complaints on the complaint platform, it would be interesting to know how many of those people identify themselves as self-employed, because some of those credit cards could very easily be business cards, but people don't really understand that. I love CDFIs, but there's only one in the state of Indiana, which means it's 3.5 hours away from almost everybody. And so I think that, clearly we need a lot more activity by a lot more players. And one of the things that really comes up in my conversations with people who are small businesses or, like I said, identify themselves as self-employed, but I really are small businesses, is the lack of knowledge and information and education about what it is they're doing. And I think of all of the effort we've put into housing counseling, I think we need almost an equivalent effort in sort of the small business world. I spend a lot of time with people who have never done a profit and loss statement. They don't know what it is. They don't understand how to track their expenses in terms of, and so we see them because they've messed up their income taxes. And so I think when we're looking at this space, we should be considering, essentially the way we try to get people ready for a mortgage, getting people ready for a traditional kind of small business loan should be an important piece of this.
And Paulina, did you had a, okay, great. Seema?
Well, similarly, I guess I was curious if you were seeing trends in terms of people using their home equity line to cover their business expenses. I know we saw a lot of that during the foreclosure crisis. And then I was also curious about sole proprietorship. How much demand is there for microloans? Do we have a sense of that? Just wondering in terms of appetite for credit.
Well, we were talking about the home equity lines yesterday, and so it might be good for Julie or Judy to talk about that. And it's something that we have seen. But in terms of micro enterprises, it's something that is extremely the demand is there in California. And yeah, banks are not necessarily going to make, and they're not going to make the $10,000, $15,000 loan. And so I hear very clearly, and it is true, there's parts of the state in California where there isn't a CDFI. There are rural parts of the state. And so how does that work? Because, I was going to give the example of, there's, and Luis Granados, one of our members with Mission Economic Development Agency, they just became a CDFI recently. There was a woman who was making tamales out of her home. Right? And so she was a sole proprietor making those tamales out of her home. They provided her technical assistance. She's now got, something like 15 employees, right? And they provided a loan to her. The bank wasn't going to make that initial loan. In fact, I still don't think she has bank lending. So how do we whether she thought of herself as a business at the very beginning, I don't know. She probably does now. And in the rural parts of the country. And that loan from Mission Economic Development Agency, they're getting support through banks, right, to be able to make those loans. And so how in rural parts of the country or rural parts of the state in California, where there isn't a CDFI, what is the other mechanisms for that if banks aren't going to make them? Or do banks need, should banks be figuring that out? Because if they're not going to make them, somebody has to make them. And it shouldn't be the predatory online lenders. Are there other types of alternative lenders, online lenders who are responsible, but who's doing the technical assistance?
Thanks, Neil, and then Ruhi.
Sure. I have some thoughts about, Paulina, your observation about large banks' use of cards, supply and demand. And I think that the graph that you have there that shows application levels and satisfaction levels with large banks would largely point to the fact that there is a product gap. I think that one of the reasons there is that, in my opinion, if you look at the loan test for small business under CRA, it's probably, my experience, the hardest one for a bank to respond to because there is kind of looking for eligible, credit-worthy clients in a low, moderate income community on a mass basis to meet that, that obligation is very difficult. And I think that banks, I would say, over-rely on credit card as a way to meet the CRA obligation, which doesn't necessarily meet the need of the community. So I would agree with you on that. I think that the challenge, and I do think that what will happen, and I think it's starting to happen now, is that fintech and online lenders are putting some pressure on banks in this space, and I think your data would suggest that as well, which is going to make it harder for banks to kind of meet the CRA obligation, which hopefully will allow banks to think about product innovation. I do think that there's some connection, though, to some of the data that we saw from the emerging small business studies that are going on. Right now, I think that the solution is to actually start to segment small businesses in low, moderate income communities by industry, so that what we can then do is kind of see what is the level of credit worthiness. Because if you take a nail salon, a manufacturer, a restaurant owner, and an accountant, each one of them has a different credit profile. Each one of them would have a need for a different type of product. Each one of them would have a different level of capitalization, all of which is a factor that has to go into the design and the development of a creditworthy product. So to your point about the ecosystem, I do think that it's going to require work with regulators and community organizations and financial service providers to find a solution. And in my opinion, and I was alive and working on CRA when it was invented in the 70s, okay? It's right now not an effective way to measure the impact on a low, moderate income community by just following the rules.
Great. Thanks, Neil. Ruhi?
So a couple of quick points, and then some New York data. Interestingly enough, the industry segmentation. So we have a City of Rochester, and the small business folks who are doing the data in the City of Rochester were on one of the calls with the CFPB on 1071, and that was exactly the point that the researcher made, that he really needed industry-level data to see how effective, government subsidies were, federal, city subsidies were. So I'm heartened to have a banker make the same point. The point I want to make, and actually I did not look at all these slides before. I looked at a few and then saw later. So New York, and multiple markets in New York, I think I mentioned earlier, I can't remember in the public section, but we have data for Nassau, Suffolk County, we've cut data for Albany, and we've cut data for Rochester, and we've cut it for the largest depositories, 8, 10, depending on the market. That's essentially 75% of the depository market share. And I was going to make the point later, but I'll make it here. So whether you're looking at Nassau, Suffolk, or whether you're looking at you essentially, you've got the 3/4 of the depositories with the market share of deposits only doing 25% of the small business lending, or maybe 30%, and that it'll vary a little bit whether you're looking at LMI or businesses with gross annual revenues under $1 million. So I was, so who's lending? And I was like, it's just like California. And to be honest, I was naive to be surprised, but it's American Express, it's Chase, and again, exactly what Paulina said in our meeting with Chase when we were like, what's going on with revenues under $1 million? Well, it's credit card lending. And, you know, the Rochester, I met someone who did not know who Kodak was, but someone else yesterday was telling me that, well, isn't it all Kodak and all those? No, it's not. It's not Kodak. It's not Bosch and Lomond. It's not Xerox. But it's people who used to work there who've now started businesses. So it's not like it's intellectual capital that needs money. And they can't do that. I mean, they can't do it on, and we're hoping to do more detailed work around this. But how are we going to turn the economies around of Rochester and the whole Midwest and that 90 corridor if, you know, our banks aren't lending? And then a whole other, you know, because that's what's also happening in the mortgage market. And then, and then I look at a bank and say, okay, what's your community development lending?
Ruhi,
I'm done.
thank you. I love you, but thank you. Tim.
I was hoping to get your perspective on online lenders. I noticed quite a gap in net satisfaction, but I was also wondering if it's largely driven by the segment they're filling, which I think is quite different from what the banks are filling in terms of loan size and speed and type of loan. And what predatory practices are you seeing?
Well, I think we're seeing, you know, high interest rates, and you know, and then so that's the primary predatory practice. And then if you go, like the other day, I was on an online lender's website, and I don't know if I'm supposed to name names, but so I won't. And you couldn't see, there was no disclosure of the APR anywhere on the website, right? So if you there's some discussion of fees, but there's no disclosure of the APR. And so you sign up for a loan, you get a quick turnaround, and so often it's people's last resort, right? Either they think they're not going to get a loan from a bank, or they've gone to a bank and they've been declined, and they're going to the online lender as the you know, last resort, or maybe the first resort, because they think they're not going to get a bank loan. And so what our members are saying to us, you know, and we heard this again and again at every meeting we have with them and with banks, or with them and with regulators, is that they're having to refinance people out of these loans. And sometimes it's because they're so deep in the hole and they can't get out of them. Or in some business, and sometimes they can get refinanced out, and sometimes they can't. And they lose their business, and so that's, you know, and so that's what we're hearing again and again from our members who are CDFIs. And that's, you know, that's a shame. And so some of it could be, you know, and so there's the size of the loan, that's where they're going. They're not getting it from the banks. And, you know, the other is that banks are also now doing partnerships with these, you know, on deck. I think Chase has a partnership with On Deck now. And so they're becoming more traditional in that way. And they have some kind of firewall so that they're not doing the predatory lending with the bank, but it's still, you know, as I was saying to the other day to somebody, it's, you know, you're still in some ways legitimizing that product, because that you know, it's On Deck is now seen as somehow legitimate, even if there's that firewall. You know, they may not be going to the predatory product, but that product, you know, may be, you know, if they're getting declined, they may go there next. So mostly it's the predatory. And in terms of the satisfaction, you know, it may be that people are also not able to, if they have a problem, who do they go to? If you have a bank, you know, you can walk into the bank and talk to somebody. So that's the other issues.
I have 4 people lined up to comment, and I want to actually see if I can get your permission to push you for the last session of the day, small business. We're going to be hearing from CFPB staff. I don't want to push you if you have questions specifically for Paulina. So if anybody of my 4, Josh, Alyan, Kathleen, Lisa, are you questions specifically for Paulina, or can we hold? We can hold? First, okay, Kathleen.
The slide that looks like how I imagine Amtrak runs the railroad. I'm confused about a couple of things, and I just wanted you to help me clarify. And one is that under the application rate, where it says 50%, I don't understand what that's 50% of.
So it was, my understanding is of those that they sampled, of those that they surveyed, because they surveyed small business owners,
Okay. So
how many?
50%
Right.
of the owners applied. Okay, great. And then I have another question. I mean, of the borrowers. And then the other question I have is where it says just next to it, 77% satisfaction, and it says it's a net satisfaction, and then it describes that among the approved firms, the share satisfied minus the share dissatisfied. So this would have to be 23%.
You're going to have to ask the Federal Reserve.
Okay, that's really confusing. Okay, and my other thing is just a quick point. I think that what your charts demonstrate, especially the one over time that was a bit earlier, is how the CRA is improperly aligned. It should be countercyclical. All the incentives in CRA is for banks to do their lending during periods of growth and prosperity, because they want to do, the reward they get for a satisfactory or superior rating is that they can acquire branches, they can merge, and during bad times, they don't want to be doing that stuff, right? They're battling down the hatches or whatever the term is, and they're not doing a lot of lending.
Yes, but I also want to remind everybody that 96% of banks get a satisfactory or better rating, and I don't think that goes up and down during bad or good times. And so it's just there's great inflation, and but yes.
So it may not even have anything to do with the ratings.
Well, and because they're
Money during bad times.
right, and they're graded compared to their peers, so.
So maybe what it should be is that they get graded based on how many CRA loans they make, period.
Well, and there is a community need survey that's done, a performance, yeah. so.
Neil, you have a question for or clarification
Well, just
on
a
this
statement
issue?
on behalf of large banks everywhere. So one of the major factors that go in, so each bank has a different exam cycle under CRA. Sometimes you get caught in a bad economic cycle. That's happened to me once. Sometimes you get caught with some wind at your back. Isn't that great? But I don't necessarily think that it's kind of conscious thing like banks will hold back and wait for a roaring economy to try to help, because you just can't. The other thing is that the government is notoriously inconsistent about lengthening and shortening the level of exam periods. So,
Thank you. No, I appreciate that. There's lots more to be discussed, but we've cut a little bit into time for Lynn, and I want to thank you, Paulina, for your presentation, and move us forward into hearing from Lynn. Thank you so much.
Thank you. I really appreciate being able to speak about reverse mortgages.
Are you teed up? Is the reverse mortgage? They're working on it. Okay.
Okay. Yes. Just very briefly, I understand we are somewhat limited on time, and I will go ahead and start. Reverse mortgages are somewhat of a specialized loan because you can only get a reverse mortgage if you're 62 years or older. So most of the clients that I have that are coming in with what I will call servicing problems with reverse mortgages are in their 70s, 80s, sometimes 90s. The other unique thing about reverse mortgages is that you do not have to make payments. So basically the title of my presentation relates to reverse mortgages sort of being pre-January 10th of 2014 all over again. And the reason for that reference is that I think that borrowers and servicers alike with regular or forward mortgages found that the RESPA regulations, Regulation X, specifically relating to loss mitigation, made a really positive change in the mortgage servicing world. Unfortunately, they do not apply to reverse mortgages. So even though reverse mortgages can be beneficial, albeit expensive, we're seeing a lot of problems with the servicing of reverse mortgages for which there is little to not very effective oversight. I took some information from the CFPB, some of the CFPB publications, and as of April the 1st of 2017, they had handled over 2,800 reverse mortgage complaints. The interesting thing about the next statistic is that there are, as I mentioned, there are no payments on a reverse mortgage. So the only way you can find yourself in default of a reverse mortgage is if you fail to pay your property taxes, if you do not keep your insurance on the property, if you move away from the property permanently, or if you die. So those are the three general categories we'll talk about today in the problems that I'm seeing with reverse mortgages. The reason why that statistic that from July 2011 to 2017 is interesting is because most of the common issues identified with reverse mortgages are payment failures, collection problems, and loan servicing payment problems. So 72% of the complaints were relating to payments and loan servicing and collection on a mortgage for which there are no payments due. The other interesting statistic I took from the CFPB, who has some really wonderful publications in this area, is that in general speaking, the debt collection is the highest volume of complaints that they're seeing from consumers, but from the older population of consumers, mortgage complaints are just barely above debt collection complaints. I've mentioned some of the basics of reverse mortgages. Again, the borrower must be 62. The borrower either takes the proceeds of the loan in a lump sum or through monthly payments or as a line of equity. Generally, we are seeing that the borrowers are taking out the mortgages as a lump sum so they can pay off their either initial mortgage or the mortgage on their home. There are no monthly payments, but there are really expensive servicing fees that are charged and taken out of the equity of the home each month. And then the loan amount is based upon basically the appraised value of the property and the prevailing interest rates, but also the age of the borrower. So the older the borrower, the more money that can be borrowed. So the problems that we're seeing in the area of taxes and insurance defaults are that many consumers are coming in because they are being offered that they fall behind, they miss a year worth of taxes or they miss a year's worth of insurance, and so the borrower either pays the taxes or the servicer pays the taxes or force places insurance. And so one of my clients had come in because he was being, an 80-year-old client was being foreclosed upon because he owed $885.66 in taxes. And so he was on a repayment schedule where he was making double payments, and he thought he had made all of the payments toward the $800, but he received a letter saying that he owed $80,000, which was the entire principal balance, or he would be foreclosed upon. And then he was a foreclosure lawsuit was filed. And so in that foreclosure lawsuit, I also included Equal Credit Opportunity Act claims because it occurred to me that the population of people who are 62 and over are being treated in a disparate manner when it comes to the collection of these types of mortgages because of the effect that these confusing letters are having on this population. And the judge found that just saying that this gentleman was mistreated was not necessarily showing a disparate impact, and it was unfortunately very easy for me to find with this same servicer an 87-year-old borrower in New Jersey who was being foreclosed upon for about $6,600. And most of my clients who are being sued in foreclosure who come in for taxes and insurance problems owe somewhere between $2,000 and $6,000. I also found another woman, same servicer, who was being foreclosure was filed because she owed $49. The problem with the property charges, and this is real property, homeowners insurance, HOA, COA fees, that a lot of times the servicer will pay the taxes before they're even due. And a lot of times we find that people who are 62 and over are on repayment plans with their tax collector's office, and so the servicer paying the taxes messes up the special plan that they have. And the reason why these sort of confusing, at best, problematic foreclosures for very small amounts are problematic is because last year a report published by HUD found that almost 20% of the reverse mortgages that were issued between 2009 and 2015 had taxes and insurance defaults. And if you break that down to 1 year, in 2015, you had over 24,000 borrowers who are 62 and over by definition who are in default for taxes and insurance. One of my other clients was being sued in foreclosure because she owed 27 cents. The way this came about, and actually this was the second foreclosure that the servicer had filed in 2 years. The first was filed because they claimed that she was no longer living in the home. They served the initial foreclosure papers on her at her home, and then they did dismiss that lawsuit. And then just a little while later, in 2016, they filed a foreclosure because she owed 27 cents. So as it turned out, they thought that she had failed to pay insurance in 2011, but they didn't raise this issue with her until 2015. They sent her a letter saying, you owe us $423.30. So she sent them immediately $423. So they sent her a letter saying, you owe us $$3. And so she sent them a check for 3 cents. Without sending a letter letting her know, you owe us 27 cents, please pay this or we're going to file a foreclosure lawsuit. They just filed the foreclosure lawsuit. So it was interesting. I was in a hearing on this case the other day on another matter, and I was explaining to the judge what I just told you, expecting for the attorney for the servicer to look at the judge and say, oh, no, judge, we would never file a lawsuit against a 90-year-old woman because she owed us 27 cents. And instead, his answer to the judge was, we did, but HUD makes us do it, which, as you'll see, is not actually correct. There are a lot of mortgagee letters and servicing guidelines that HUD has provide loss mitigation opportunities or opportunities for the borrowers to pay their taxes and insurance defaults before foreclosure, but we are finding that they're not being followed. There are special provisions, and I'll go through these pretty quickly because they're on the HUD website as well as in servicing guidelines. But if the amount owed is less than $2,000 or the borrower is over 80 years of age, then there are special considerations. Non-occupancy defaults, I mentioned that our client who was sued in foreclosure for not paying 27 cents had been sued for non-occupancy. If you look at the actual mortgage in the note, there is a requirement that the borrower remain in the property. And there's a default if the borrower fails to occupy the property for more than 12 consecutive months. What really happens is not that those are the only events of the default. The real event of the default is if the borrower fails to return a postcard or a letter saying, yes, I still live in the property, and if the borrower fails to do that every year. The problem is that letter, that postcard, is more frequently going to come from a company that the borrower is not familiar with because it's not going to be the name on the mortgage. It's going to be a subsequent owner. It's going to be a subsequent servicer. So even though that returning of a card is not required by the note, the mortgage, the loan agreement, HUD regulations, HUD servicing guidelines, or any other written requirement that can be imposed on the borrower. I took a deposition the other day, and I learned from the servicer that they make these rules up based upon industry best practices, and where they find the industry best practices is from a trade organization. So I asked, how is the borrower supposed to know what your industry has determined what are the best practices? And how is the borrower supposed to know when they change? Because they do change quite frequently. And there really wasn't an answer to that question. This deposition was taken in a case relating to a 70-year-old client that I have who was being sued for no longer living in her property. And during looking at the servicing notes and asking the servicer about the servicing notes, we learned that 3 or 4 times during the period that she was being foreclosed upon and claimed that she didn't live in the property, she was having direct communications with the servicer about a taxes and insurance issue, because they were saying she owed flood insurance. She said, I don't have to buy flood insurance. And she also returned this card before the foreclosure was filed. Even though the mortgage and the notes say that she has to be able to reinstate the loan by fixing whatever problem that they claim is the cause of the default, they still filed the mortgage foreclosure default based upon what the industry trade association said. And also, we had another gentleman. This filing of the foreclosure lawsuit for non-occupancy when the borrower still lives there is very common. In that instance and in this instance with this client, in both instances, they were served with the initial foreclosure papers at their home. So either service was bad or they lived in their property. Again, his default was that he failed to return this non-occupancy card. And so we also learned that at that same time he was having communications with the servicer, but he was talking again about taxes and insurance, not with the occupancy wing. And so when we asked the person at the deposition, how can you explain how you're speaking with this gentleman, he's sending you checks with his home address on them, at the same time you're suing him for non-occupancy, how do you explain that? And the answer was, you're trying to make logic out of an illogical situation, which was disturbing on many levels. And it's very interesting because this gentleman in particular, and I know myself and many others, we always tell our parents when somebody calls and it's a number you don't know, don't answer the phone. If you get a letter or something from somebody that you're not familiar with, throw it away. If somebody comes to your door and you don't know who it is, don't answer it. And certainly don't answer any questions for any of those categories. And so his sons the gentleman had been a victim of identity theft, so his sons had told him, don't you answer any of these communications. Very quickly, with the non-occupancy, with the death defaults, there has been quite a bit of litigation in this area because the regulations say one thing and the statute says another. Most oftentimes, if a borrower takes out a reverse mortgage, and their spouse is under 62, the spouse will have to deed the property over to the older borrower, or there will be some event similar to that, and the borrower is told, don't worry about your spouse as long as your spouse is still living in the homestead and it's their homestead. They're not going to be, the foreclosure lawsuit will not be filed if they're still living in the property even though you die, which is really a key interest of the reverse mortgage borrowers. So the regulation and the statute were somewhat different. One protected the surviving spouse, homeowner, and the other protected the surviving borrower. So if you take the borrower off the note, even though they're on the mortgage, they were not being protected. There have been many complaints to CFPB relating to that sort of thing, and there have been some steps taken to make sure that originators are not telling borrowers at the outset that their spouse is going to be protected when they're not. And so the last slide I have relates to heirs, and we were talking about the problems that survivors, whether they're forward or reverse mortgages, is servicers not speaking with survivors, even if they are on the title to the property, even though they're a personal representative in probate and they're entitled to the property. It is equally difficult for survivors of reverse mortgage borrowers to speak to the servicers, and survivors, if they don't have to pay off the entire mortgage. They only have to refinance the mortgage or pay it off at 95% of the current appraised value, which is a very important right to heirs, but if they can't talk to the servicer, then they can never exercise that right. So I really appreciate the opportunity to speak to that. I think there's a lot of opportunities for education, and I understand there may be some thoughts of oversight and perhaps even regulation, but I do appreciate the opportunity.
Thanks so much, Lynn. Huge problem. And appreciate your presentation. And Judy had her hand up before you had even finished speaking. So, Judy?
Thank you, because this is a huge problem. And, we heard just a little while ago that foreclosures are going down, which is wonderful for everybody, but we're seeing these on the rise, at least where I am. And I just wanted to echo what you said and to point out that as we've been moving away, as the servicers, I think, are becoming smaller and, frankly, in my opinion, less trained than they had been before, we seem to be having more problems with these. They don't recognize what these are even. So even when they're bringing a reverse mortgage foreclosure and you try to point out to them, what it is, there seems to be a lot of confusion. This last issue on the 95%, I have raised that. Usually I see these, not thankfully for the crazy things you're saying, but I see these more often when the death of one of the spouses. Even when I have raised that the spouse has this option of repaying, they deny that even exists. So there's a real lack of knowledge there that needs to be taken care of. And the other thing that we see a lot of is that many of, the seniors and low-income seniors especially can get tax waivers for the property tax. So that, in a sense, they may not even owe any property tax, but by the way that the mortgage is done and that the servicer, is paying things, it messes up those free taxes. So basically you find somebody, being foreclosed for taxes that they don't even owe taxes because there are no property taxes because of their age and their income. So I think this is an area that really needs a lot of work. And my last thing to say is that the servicing, sort of the loss mitigation rules don't apply to them. And even this, like for instance, in our state, we have still have mediation programs and things. They don't apply to these mortgages. So this is a really big hole that a lot of people are falling through that really needs to be plugged.
Thanks, Judy. Josh?
I really want to echo comments that Lynn made and Judy made in saying that in New York City, this is a huge problem as well, and that advocates there who work with borrowers are identifying this as sort of the biggest issue right now, and that reverse mortgage foreclosures are really skyrocketing in an alarming way, a lot of times triggered by property tax defaults and the way that servicers are dealing with these. So just to reiterate the problem, it's such a big issue there that advocates this year got a change in New York state law so that reverse mortgage foreclosures are included in our settlement conference law, and they hadn't previously been included. So it's not just a Florida issue. It's really it's a big issue everywhere.
Did you have comments on any of this, Lynn?
No, it's interesting to hear, and I understand that different states are looking into pre-origination counseling laws, which I think we already have on the books at a federal level. So it really is encouraging to see what is going on in New York, as well as California relating to the survivors. And I guess the one point of bringing up the tax, how easy it was for me to find very low foreclosures cases filed on $49 and $6,600 just with a Google search and pull up pleadings and talk to the advocates. It really must be a national problem.
Yeah, Ruhi?
So that kind of begs the question. It's taking me back to my days when I would see predatory loans, and you would see that really they were never made to be sustainable. They were made to grab the property. And I mean, what Josh is saying, and I apologize, I'm actually not up on the HECM stuff in New York, though my office works on it. it's like they're somehow, deceptively, like they're like figuring out, okay, we can figure out how to grab X% of them with deceptive practices. I mean, this doesn't add up, except, frankly, evil, horrible intent.
If you press your mic button, sorry.
Oh, I'm
Rudy? No problem, no problem. Yeah, to add to this, we're noticing property tax payment problems with forward standard mortgages, not just reverse mortgages. Servicers are jumping in to pay mortgage taxes when our clients have always been paying on their own property taxes. They're not in the middle of a loan modification where modification rules would require escrowing. They haven't applied for a modification, but servicers are paying property taxes. To us, it's bizarre. It feels bizarre, similarly bizarre, where you're trying to make some sense out of it. So you don't want to impute ill intent, but you want to know, well, why? Why would you do this? The person's late. We're noticing servicers across the board, not just on reverse mortgages, jumping in very early to pay property taxes, which is so troubling because somebody can be foreclosed on, not only for non-payment of property taxes, but they can make a repayment plan. It's really where I wanted to go with this. They can make a repayment plan with a tax assessor's office. In our state, you can make a repayment plan even if you're several years behind. And of course, you're more likely to be foreclosed on in some ways if you're struggling with payments or you have income fluctuation and you're preparing for those property taxes, but okay, my income's going to dip here, but I know I've got to set money aside because my taxes are due on such and such a date. We have many elderly clients who very consciously set aside money to be sure to make that property tax payment or pay on their repayment plan.
Yeah, and oftentimes the homes are older homes, and so you find that they're needing repairs. And so a lot of times the problem with the insurance is not the inability to pay for the insurance; it's the inability to find insurance because of, a porch may need repair, a roof may need repair, pipes, so for those sorts of things. So that not only creates a burden on the expense of doing the repairs, but also either getting more expensive insurance or not being able to get insurance at all.
Other comments? Well, one more thing I would note that I've run across both with forward and reverse mortgages is people being told that they're dead. Hello, you can't exist. Right. You're dead. Why are you calling me? Really bizarre. I mean, it's utterly bizarre. But that tells me that there's a system in place, and that's automated, and I believe that it may be tied to the Social Security system, where servicers are automatically receiving notification of some kind that, well, you should have been dead by now, and therefore we're not going to talk to you. We've seen people having trouble dealing with their credit report, getting locked out of accounts because also credit reporting agencies think the person is dead. So there seems to be kind of some larger systemic problem of some kind that was, again, not intended to tell people who were alive that they were dead, but intended to make it easier for some part of the collection side of the house or the servicing side of the house maybe to keep track, or the credit reporting side of the house to keep track of what's going on. Josh?
Yeah, sorry, I don't mean to keep going over and over this, but I think it is important to to Mavis' point. There are ways for seniors to work out payment plans on their taxes, and there are exemptions that people are missing. And even in the sort of the bad days of predatory lending, you weren't seeing these kind of servicing practices with reverse mortgages in the way that you're seeing now, where there was no willingness to work with the senior to maintain the home, and there seems to be a real trigger on foreclosures. And it seems like it's being driven by servicers, by who's servicing these loans right now. Certainly in New York, most of the problematic ones are with Champion and Financial Freedom, One West, and so it may not be. I mean, they're holding a big chunk of these reverse mortgages, but it seems like it's servicing practices by individual servicers, and there's a need to look at that.
and I'm not sure if this is the cause of both of the problems, but what we were finding, the problem with having these sort of secret to the borrower rules is that you have the servicer handling the telephone calls and the letters, but they're outsourcing the letters and the telephone calls to to other entities. And so if you have rules that are changing every 6 months or so from a trade organization, and then the people from the servicing company that happen to go to the convention coming back and trying to get that information to an outsourced third party, it's almost like the rumors game, and by the time it gets to the end, you're not getting good information at all.
You know, there was some study that says that most people, when they hit 50, lose a certain significant part of their cognitive ability. I'm just saying. So it's just,
Can't remember what it is.
there's some reports sometime, I think. But, so this is a particularly vulnerable population, usually well over 50 by the time we end up talking. But certainly to qualify for the reverse mortgages, they've got to be at least age 62, just particularly appalling. And I think about our elder financial protection abuse statutes, and as Lynn pointed out earlier, about the things that we tell seniors to protect themselves from fraud are things that some of the servicer behavior fits into that looks fraudulent, even if not intended to be. So, Judy, and then maybe we can think of wrapping up this section.
Just really quickly, well, first of all, if you ever want to fall down a rabbit hole, try to prove somebody's not dead. It is the most complicated thing I have ever tried to do. It is insane. But what I really wanted to comment on is when we're talking about, maybe space that needs to be regulated, another consequence of this is, is even if you get this poor lady who owes 27 cents out of the foreclosure, because they filed it, they've now piled on all sorts of fees and the costs of a lawyer and all of that stuff that then this poor person who never should have been foreclosed on ends up having to pay. That causes the secondary problem. So those kinds of things, it accumulates and it gets bigger and bigger. And so that, I just wanted to make sure we didn't forget that little piece of it.
Thank you. Any final questions for Lynn or comments by Lynn?
So can I just, as a legal services lawyer, I know the financial industry sometimes gets kind of frustrated with us as we talk about protections for clients, but this is our world. I mean, this is what we've dealt with our entire working lives, and it's sad. I mean, I want to cry when I see that slide, and so anytime there's a new product or anytime we're my attitude is, tell me how you're not going to rip my clients off. And that's where I'm coming from. And I'm not going to apologize for that. I'm really sorry. Every single product, when someone says, I'm going to be really good for your community, I'm going to say, prove it to me, prove it in numbers, prove it in dollar amounts, prove it over time. And I want a regulatory authority that's making sure you're doing the right thing. I'm there. I'm not changing right now.
Thanks, Rudy. All right. Thank you, Lynn. Thank you for your time. I'm wondering if we can go ahead and bring up small business folks from the Bureau for our next session and start that a few minutes early. Would love that. So our final session of the day continues the focus on small business lending. We've heard perspectives and expertise from our CAB member, Paulina Gonzalez, who unfortunately had to leave a little early. Now we'll hear from Bureau staff about how staff are moving forward in addressing this newest body of work, huge body of work that they're undertaking. And then we'll get feedback from the CAB on this work. And to lead this conversation, we have with us Alan Ellison, Small Business Program Manager, Office of Small Business Lending Markets, Elena Babinez, Senior Counsel in the Office of Regulations. Grady will perhaps be joining us, is on his way. Grady Hedgepeth, Assistant Director of the Office of Small Business Lending Markets. Thank you so much for coming here this afternoon and being here for this final piece of our day and our public session. And please, CFP Beers, take it away.
The conversation earlier on small business, I think that sets us up. Is it on? No. Oh, okay. Yeah, thank you for that conversation on small business earlier. It was really kind of sets us up.
Okay, well, thank you so much, everyone. It's great to be here. As Maeve said, my name is Elena Babanez. I'm Senior Counsel in the Office of Regulations. I'm the project lead on this 1071 project here at the Bureau. I'm very excited to be here with all of you today and to discuss our work on the business data collection rulemaking. Today's session is going to focus on the request for information that we issued last month. In conjunction with the field hearing that we held in Los Angeles. And as many of you already know, we also issued that same day a white paper. Before we turn over to that discussion, thank you. Before we turn over to that discussion, I wanted to turn it over to my colleague, Alan Ellison. He's the program manager in the Office of Small Business Lending Markets to provide an overview of that market.
Yeah, I mean, most of this data we went over yesterday, but I'll just, thank you, get the kick out of this. Yeah, but for the, I'll go through this briefly, even though we did cover some of this, given this is a public hearing. The thing that really sets up, and of course sets up 1071 and the need for it, is the overall importance of small business to the overall economy. And, the various statistics are generally well known that approximately 98% of all businesses in the country are generally defined under most definitions of small business as small. And it's approximately 27.6 million businesses. And of that total, about 22 million are those that are sole props without employees other than the owners. The 98% number stems from an SBA definition of businesses with less than 500 employees. But if you looked at just $1 million of sales as the cutoff, it's about 95%. They employ approximately 50% of the total private sector workforce in the country. And if you go back to 1993, 2/3 of all new job creation has occurred from small businesses. The majority of small businesses are ones where they have one or two owners, and a significant portion are owned, either female-owned or minority-owned, and particularly in LMI areas where we're relying on small business to help drive development. And if the estimates that we have is approximately $1.4 trillion of business credit ties to small businesses. And that's all forms of small business, and that's what we've been able to derive from using various public and private sector sources. And the purpose of 1071, which Elena's going to go through, is going to allow us to have new insights, and Elena's going to talk about some of the statutory purposes of that data collection. So, thank you.
Thanks, Alan. So Section 1071 of the Dodd-Frank Act, what did that do? That amended the Equal Credit Opportunity Act, and it requires financial institutions to compile, maintain, and report certain information to us, the Bureau, about applications for credit from women-owned, minority-owned, and small businesses. What is the statutory purpose of this data collection provision? As you see there on the slide, it is to facilitate enforcement of fair lending laws, and equally important, it is to enable communities, governmental entities, and creditors to identify business and community development needs and opportunities for those groups, for women-owned, minority-owned, and small businesses. You'll see there on this slide, we've listed the statutory elements that Congress specified in Section 1071. Those are the data points that Congress has told us we would need to include in the rulemaking. Those are data points that financial institutions would need to compile and maintain. They would need to submit that information annually to the Bureau, And we, the Bureau, would make that available to the public upon request. Of course, unless the Bureau determines that we need to delete or modify any of that information to advance a privacy interest. All of that language that I just went through, you'll find right in Section 1071. And hopefully, I don't want to get too much into the statutory data points at this point in the presentation, but hopefully we'll have time later on to do so. Before moving on, what the last slide, as we've learned working on this project, a lot of times you prepare decks, and as you're, you develop the decks, and as you're preparing to actually do the presentation, you think, well, maybe we should have switched those slides. So I'm going to do that right now. One of the last slides on this deck that you've received on this PowerPoint was a summary of the road ahead for this project. I think it's most useful to cover that right now so that we can then just dive right into the request for information. So I wanted to go through quickly what we've accomplished in this first year since the Bureau's Office of Small Business Lending Markets came to be. First, we assembled an expert team led by Grady Hedgerspeth, who is the Assistant Director of that office. We've engaged with over 50 diverse stakeholders to date. We are looking forward to continuing that engagement. We've also, as I mentioned before, in conjunction with the field hearing in Los Angeles last month, we issued a white paper as well as the request for information. We also thought it would be useful to provide an overview of what the rulemaking process will involve. This comes up often in conversations we have with stakeholders, so we thought it would be helpful to provide that overview here. So right now we are, as demonstrated by our white paper, we are actively involved in market insight and research. We're also underway is our stakeholder input. We also, of course, look forward to receiving the request for information responses that we receive. The next stage would be to hold the Small Business Regulatory Enforcement Fairness Act, also known as SBREFA panel, that many of you are probably familiar with. Following that, we would issue our proposed rule. Then would follow a comment period where we give the public a period of time to comment on the proposed rule. We then, of course, carefully look at those comments, and the next major stage would be to issue a final rule. Following that would be an implementation period. And lastly, of course, the effective date of the final rule. For those of you that might be familiar with the Home Mortgage Disclosure Act, HMDA, this should ring a bell. It's a very similar step-by-step process that we follow here at the Bureau. So Section 1071 of the Dodd-Frank Act states, as you see there, that we shall prescribe such rules and issue such guidance as may be necessary to carry out, enforce, and compile data pursuant to this section. As indicated in a letter that was issued by our General Counsel back in 2011, the Bureau does not interpret this particular provision of the Dodd-Frank Act 1071 to require financial institutions to begin compiling, collecting, turning over that data to us until we, the Bureau, issue implementing regulations, and those regulations actually take effect. So we are in that stage of working on the rule, and again, there's no requirement for a financial institution to submit anything to us until that rule, a final rule, would take effect. The other thing that we're often asked when we meet with stakeholders is, when will the rule be issued? That's I can say that we are actively involved and engaged in the rulemaking process. It's too early to predict when the Bureau will complete this important rulemaking and how long that implementation period would be. I think a lot of the feedback that we hopefully get from you and others would inform things like implementation period. I think we'll have a better sense of timing the more the more we get engaged. For example, when we get the request for information responses, which if you've had a chance to look at the RFI, the questions are quite complex. This is a market that we really need to study well in order to have a balanced and workable rule. So I think, once we get more engaged in that process and continuing conversations with you all, we'll have a better sense of timing. As we've said before, also, we're at the early stages of what we've called our outreach and research stage of this rulemaking process. So we're focused on that, and we're particularly, as is highlighted in the request for information, we're particularly interested in understanding certain things about the small business lending market. For example, the institutions that extend such credit. What is that credit? What are the credit products that are offered to small businesses, including minority-owned and women-owned businesses? The recording systems that financial institutions have in place or may have in place as a result of this new rule. The underwriting approaches are there's a variety of underwriting approaches, so we want to understand that. We also want to understand the distribution channels that are involved, as well as, of course, the types of applicants in this market. So a key part of this outreach and research was the issuance of the request for information. And as Director Cordray mentioned this morning in his opening remarks, we've extended the deadline to respond to the request for information by 60 days. We hope that this additional time helps all stakeholders provide thoughtful and thorough feedback. And as we've said before, and I know I say a lot, the feedback we hope to receive from all of you, both in response to the RFI, but also with stakeholders, on the ongoing meetings that we plan to have with stakeholders, that really is a critical way for you to inform our policymaking on this important topic. So we really encourage you, if you can, to please submit responses to the request for information. It's a long list of questions. If there's particular ones that you would find particularly helpful to provide responses to, then do that. So again, really looking forward to that feedback. Before I turn to the next slide, I just wanted to say, actually, that this is probably a good time. So switching gears to really focus on the request for information, which was the purpose of this presentation. As hopefully you've seen in the request for information, there's 4 areas of interest. Before diving into those and hopefully hearing from you, I really wanted to talk quickly about what does the Bureau hope to gain from the RFI. Again, we really hope to learn more about the small business lending market, and in particular, as discussed by Alan just now and yesterday with respect to the white paper, the vast majority of businesses in the United States are considered small, so we're taking a very close look at the small business lending market. By reviewing the responses to the request for information, we hope to understand several things. First, as you'll see there in the slide before you, how does industry currently define small business? We know that there's a variety of definitions that are out there. We will do our best to find the definition that is appropriate for the purpose of this rulemaking. Secondly, we are interested in understanding the financial institutions engaged in small business lending and the various products that they offer. Critical part of this rulemaking. Another important part of this rulemaking there, number 3, is input. We really hope to get input on the data points that are necessary for us to achieve the purpose of Section 1071 that we discussed earlier. And lastly, as is highlighted in one of the sections of the request for information, we hope to understand the privacy and confidentiality concerns that may arise as a result of the disclosure provision of this particular statute. Lastly, I just wanted to highlight that, and maybe we can hear a little bit from you when we get a back and forth now, is we really want to learn about the existing business lending data that currently may be maintained, reported perhaps, by financial institutions. That's an area that we're particularly interested in. So I think...
Yeah, and if I could add just one thing,
Yeah.
is we're very cognizant of the potential burdens of data collection particularly for small financial institutions, and that's something that we have solicited input on as part of the RFI.
So now we'd like to open it up to all of you to share any thoughts you might have. Let me put those 4 areas of interest back up for all of us to take a look at. Grady has just joined us. Hi, Grady.
Hi, Grady.
Let's see if I can. There you go. So with respect to, and you know, we don't have to go in order, of course. With respect to the definition of small business, are there any thoughts that any of you would like to share with us on that topic?
All right, back to our active small business list of people waiting for this moment. Lisa.
I actually raised this earlier, so I don't know if you were in the room, but I think there's small and there's micro. I think that spectrum from 1 to 500 is overly large to really say anything meaningful, and so I think the category needs to be broken down. There is, I think, still, I'll just say something about the data too. The Aspen Institute has a field program that collects data from microenterprise programs. It turns out that only a small portion of them actually report, partly because they just don't have the capacity to do it, which tells you something about the field, I think. But that's a place to look, at least for those that are more sophisticated and actually doing a fair amount of lending. And I'd be happy to communicate with you after the meeting at some point.
Let me check in with Josh first, since he was a holdover who didn't get to speak from earlier, before I go to Jim.
I mean, my comment was kind of random in this. Maybe it's best when we're talking about the types of credit.
Jim?
Yeah, interesting topic. I've done a fair bit of research that I've sold to banks and fintechs in this area, and what I've generally, I found that people either categorize businesses based on quantity of employees or annual revenue, and I think it increasingly becomes problematic to count employees because of the gig economy that is particularly the focus of smaller businesses. So I would recommend focusing on revenue, and within that, I find it the most, because I think you said, even banks themselves are all over the map on these definitions, but what I found are the most helpful definitions are probably either 5 million or 10 million in revenue. And I would also recommend checking in with commercial research providers, such as Barlow, Greenwich, and a couple of others, Javelin on that.
Judy?
I hate to disagree with Jim, but I think that is still not going to address the large number of people that we deal with that are basically fall in the sole proprietor list, but they would tell you that they're just self-employed. And I think if you go to, such 5 million and 10 million, we're talking people who are, 20,000 in revenue, and so I think you do want to have that very low end category, whether it's self-employed or sole proprietor or, under 100,000, because I think they have entirely different needs than the rest of the world.
Joanne?
Is there any reason why you're not looking at the SBA definitions of small businesses? Because that goes by category. What's small in one industry is big in another. I know that's what the Bureau uses when it does SBREFA. So, I think that can provide some clarity there.
So we are looking at the SBA definition. So thank you for raising that. If you look at Section 1071, within the statute itself, it defines small business concern and it references the SBA regulations. What we've learned from conversations with industry and a mix of industry, and of course with Grady's expertise, since he was formerly at SBA, what we've heard to date is that definition is actually quite complex. And when we're thinking about ways to perhaps lessen burden or minimize burden, but still get helpful and useful data, one of the things we're exploring is the SBA definition the most appropriate one for this rulemaking? So that's something that I think will be a major part of what we're looking at. Grady, I don't know if you wanted to add anything?
Okay. I have also a couple thoughts to toss into the hopper. One is I think about the CDFI universe and microlending and the fact that stands already exists as a notion and what that means, and it's at least a partially developed piece of the field of small business lending, is to look at what their notions are and what they are saying that they've been able to accomplish in the field of outlay for small business and what types of businesses they focus. And then I wonder about the questions that we're asking when we're trying to understand, and I think you were talking about this, Elena, or several people have talked about this. What are we asking? What's the right way to think about it? Defining a small business. Is it number of employees? Is it amount of revenue? To me, in trying to munch my way through this conceptually, I'm thinking level of sophistication is one of the questions that in some ways is missing, which could be, you could be somebody who's a sole proprietor who pulls in a lot of money but actually doesn't have an extreme level of sophistication in terms of business management. Number of employees can be an indicator of sophistication, but 500 seems like a silly level to me to set it at, because that leaves out so many of the sole proprietors. I also wonder about tax filing. You can't get access to the tax filings, but how many people file a profit and loss statement. We have so many clients who have used their home, back to something Seema had asked about earlier, how many people are getting HELOCs to finance their business? Piles. And then refinancing all that, what is essentially business debt, into their first mortgage. That has happened. Will that keep happening moving forward? I don't know. And then a couple other thoughts were, what are our expectations when it comes to access to credit for small business? What kind of access do we think that they should have? What's reasonable? And does those expectations change if it's a sole proprietorship? And does it depend on what industry they're in? Maybe it's a sole proprietorship, but we think that the industry that they're in is so complex that by definition, we know we're looking at a type of industry that requires a higher level of access to capital just to operate from day to day. So I think maybe breaking out some more questions in this definition of small business and how we approach defining it.
Maybe may I ask a follow-up question for you? Because the issue of sophistication is an interesting one. And the closest thing I have heard in the discussions we've had up till now is length of time in business. What kind of proxy do you think that might be for the sophistication you're trying to get at?
You know, for us in reviewing people's financials for the work that we do, if you cannot put together a basic profit and loss statement and have, stuff that you may have a difficult time getting to, if you don't understand basic financial concepts or that next step up in sophistication of understanding what type of paperwork to maintain as a business, understanding the difference between the cash flow for your business versus what your salary might be out of the business. When there's a complete merger of the business entity with your own personal day-to-day livelihood, how do you get to that information? I don't know. As I said, tax filings to me seem to be in some ways, an instant proxy, because if you don't think that you're a small business, maybe that's an indicator of lack of sophistication about how small businesses operate. You're probably losing an opportunity, frankly, to show your financial life in a way that's more advantageous to you. Maybe to some extent it's how much you use consulting services, frankly. I think a lot of more sophisticated small business owners will at least reach out to their local small business entity or other support services, or be members of trade associations, but that's only for certain sectors. The more I talk, the more I'm driving myself insane, because this is so complicated, and you're falling asleep when I'm talking. That's not good. But I do see more hands. Who did I see? Chris first, and then we'll work our way down and up.
Kind of in line with that question as well, and this is, I will fully admit that I am not a small business lending expert, but I do talk to a lot of my colleagues who do end up doing this work, and it gets to that sort of big difference of the size of the business as well, and sometimes the size is actually a decent proxy for sort of the sophistication, but I think especially when you're talking about somebody that's maybe in business by themselves, and I'm thinking of Like some of the loans that we see are, the guy who owns the painting company, he's got one truck, he's got two guys who work for him. He hasn't really had to do the kind of income tracking and stuff, or maybe he's doing it in the way he just kind of figured out, right? And so you have that guy who he wants to know what he needs to do, and he wants to know what would need to be successful. He just needs that sort of extra technical assistance to get there. Once that person's grown into the larger business, then they do develop that sophistication. One thing that kind of popped in my head too is North Carolina offers this, and I don't know whether it's in other states as well. I can't remember what the acronym is, but it's a technical assistance program that's run through the State Department of Commerce, and it's linked closely with the community college system. But essentially, it's a free or almost free program for small business owners to be able to actually access technical assistance to figure out ways to develop a stronger business plan, to be able to do the profit and loss things. And then half the time they get there because they've gone into a lender to apply for a loan and they're not ready yet, and the lender's telling them go to this center, get your stuff together, and then come back to us. Other times they are actually helping them get to a point, and then they are recommending them to folks off in a CDFI or somebody depending on the size of the business. But we do notice that there are a lot of these folks who have been in business for a while, and I think it's eventually somebody suggests to them like, well, if you had another truck, or if you'd be able to do this, and it's getting over that hump of the technical assistance that they need to put what they have going on into a plan that will eventually get them into a small business lending program. And then, of course, there's the issue of, if they're not looking for $1 million or more, then, the big bank isn't that interested in them. So then finding the program that is going to help them with that.
Did I see Chi-Chi and Lisa, or just Lisa, and then I'll work my way up the other table?
Just on this theme of sophistication, again, there's a really big range in terms of the CDFIs that are doing this kind of lending and technical assistance. And one of the ones that I think is most successful by many measures is Axion, which has offices throughout in many parts of the United States, does take online applications, which is really interesting because I think they're big enough and sophisticated enough that they realize that there is this competition from lenders who may not be as socially motivated. None of them are self-sustaining. Axion is probably the most closest to self-sufficient. And whereas many micro lenders will do 8 or 10-week classes for anybody who walks in the door with, really maybe a romantic notion of what it would be to start a business, and will never get there. And you can kind of tell the day they walk in the door. Axion uses a proxy of having been in business for a year. And they use a pretty loose definition of that. It doesn't mean you have to have had a profit and loss statement or filed taxes yet, but you have to show that you are making something or doing something and making some money off of it. And this also follows a little on Chris's point that sometimes, if you have people, and this is where it gets expensive, who can kind of gauge that degree of sophistication and recognize that you're a good candidate for a small loan, they can give you that little bit of technical assistance to get over the hump and figure out, okay, now it's time to really separate out your personal and your business income. Or, here's what you need to do to get all of the right permits to make those tamales not in your kitchen, but in a commercial kitchen so that you can get inspected. And those organizations, I think, play a very good role, but there's a vast difference, too. I would argue that many of the smaller ones who have very small loan funds, can't get it out the door, are providing free training to people who will never go into business. There's a lot of inefficiency there, but there are some lessons to learn from the best practices.
And it sounds like some of what you're talking about, Lisa, kind of also gets to question 3 about maybe places to go to collect data. Some of these technical assistance providers for entities that are there just for training for folks to start a small business, but probably some of the people going to them are already running a small or at least sole proprietorship.
Yeah, and we had a breakout session yesterday afternoon, and there's definitely a theme that we've been hearing when we talk about our small business work here is financial literacy. And it's coming up a lot, and it's something that I hope to connect with the director on and just give him some feedback that we've been hearing from you and from, for example, we had a roundtable in Los Angeles connected with a field hearing, and that was definitely a theme there as well. So just wanted to to point that out. As we talk about the small business definition, I heard number of employees, of course, revenue, NICS code. So you'll see in the RFI, there's a section on the statutory data elements. Let me go back to, and those are not statutory data elements. Let me go back to this list here. So one way to think about the data collection, of course, is as Alan said, on the one side, it's us having to balance the potential burden on industry that would be required to provide this information to us. On the other side, it's the usefulness of the data and thinking about the statutory purpose of that you see there on that slide. So one of the things that we've been hearing about is there may be a few additional data elements that may make the data itself more useful. So for example, when you think about small business definition, one way is that it is to define it in a way that captures certain things. Another thing that we might consider would be to capture certain data elements, whether it be number of employees, NICS code, that again could help the usefulness of the data, both by regulators, by industry themselves when they're looking at their fair lending practices and checking for potential risks there, and of course the community groups as well. So let me just, I think it might be a good segue into the both the statutory data elements and any others that folks may think would be useful for us to consider.
Judy had her hand up, and then I see Kathleen.
So actually, I was going to go back to something Maeva had said on how to collect data, and I thought of part of this yesterday, but part of it struck me today. The CFPB has been really good reaching out to consumer clinics, but there are also a whole range of community economic development clinics that might be a good source of data on this. And the other one that I just thought of that didn't occur to me is low-income taxpayer clinics. They collect hordes of de-identified data for IRS about who's coming in and the kinds of problems, and they might be able to, just give you sort of numbers of people who are small businesses but don't know it and the problems they have. I want to triple echo the need for education. And then as we were talking, I just Googled and looked up the SBA definition of small business, and all I can say is, please make it simpler than that.
Ruhi?
So I was going to move on to 2 and 3 briefly. Is that all right?
Yes.
So under 2, I think one of the things we talked about, and I wasn't sure if you were in the room when Paulina presented, was how much of the small business loans are credit card loans versus all the other kinds of loans. So that I think is really, really important. And then I wanted to get to what are the benefits and burdens associated with the collection. And someone who's done worked with banks since the 90s and looked at HMDA data, mapped it, worked with multiple lenders, looked at it over time. I mean, essentially what we do is we sit down and we say, here's what your HMDA data looks like. We are also talking to other lenders, so we have non-public information from those other lenders, and we're essentially able to bring in the community, we're able to bring in neighborhood advocates, and we're essentially able to say, here's how you can do more safe, affordable lending in what are essentially very challenged neighborhoods, where perhaps you no longer have a branch anymore, none of your people has even been within a 2-mile radius of that neighborhood, but here are the people on the ground, and they can tell you. And we obviously, to some extent, are able to do that with the small business data, but a lot of it is like, we don't know, we don't. We really need the data. I'm going to say that. I mean, I don't have to replicate that, but I think there's this, so for someone, again, who's been doing CRA work for a long time, every time there's a data, it's like the sky's going to fall, the market's going to break. So I've heard this, I don't know how many different times, as I know, as Josh, who's done some of the work with me. So, but data can be useful. I mean, somebody said data is policy. And if what you showed me, that the small businesses are the engine of economic growth in some of these communities, who's not getting it and how do we get more jobs for our folks? So that's in terms of what are the benefits of collection. I know my banker colleagues will have lots to say on the burden, but that's the benefits.
Thank you. Jim?
I just want to go back to the question that you brought up about ways to predict the sophistication. I think is the way you couched it. My experience is that with three things, and any one of these three, but obviously more is better, would help you predict the sophistication. And it's age of the president or CEO, of course, is going to be a very big deal. Another one is to what degree is the headquarters, the operating headquarters of the business, urban versus rural? I think that's really important because my experience is that people in urban Atlanta are not that different from someone in, say, in urban San Francisco in technical sophistication. But you could take a rural part of California, be far different than, say, an urban part of Georgia or what have you. So don't focus on states. Its population density, and then the industry, of course, it's industries that are tech intensive, either in product or process. So high tech, obviously, is going to be high. Farming is low, but and I know some highly sophisticated farmers and others. So.
Tim, then Kathleen.
Okay, so in terms of answering the question of what statutory data elements would be helpful in determining fair lending, I mean, if I think like a debt investor, it's really cash flow and collateral, right? And basically, I mean, even on deck requires personal guarantees for all loans. The way we think about it is, 0 to 20,000, it's basically a business credit card or a personal loan. If you go up to 250,000, you're talking about an online lender, and then maybe a CDFI or bank above a certain threshold, right? And I think personal guarantees run all the way up this spectrum. So if I'm the lender, I'm looking at, do you have a house? Do you have money in the bank? Do you have a retirement? Like that should be one of my primary factors in terms of making this lending decision, that in your cash flow. So I think that's the critical element.
Kathleen?
I have two things. I'm going to start by just adding a few things on to what Tim said, some thoughts I had. I'd be very interested in some details about the actual loan itself, the length of the term, the interest rate, whether it's adjustable or fixed, if there's a down payment, if there are things, and if so, what percent, if there are any prepayment penalties, which I think are still allowed in small business loans, whether there are any required adjunctive products like, any type of insurance or something like that, what the fees are, if there are any points, and whether the loan is secured by any property, because sometimes business loans are secured by people's homes. And my other thought related to about getting information, I know that in the New England and also in the Midwest, the state and county extension services do a lot of work with small businesses. They have training programs, they administer grants and things like that. And there are also a lot of state programs that give seed money to, it's not, sometimes it's loans, but sometimes it's actually outright grants to small businesses that are starting out, particularly in LMI neighborhoods. So that may be another source of data if they collect it in ways that are useful.
Ariane, you got bumped from the earlier session. You were one of the people waiting to ask a question. Do you have any questions or comments, I should say, that are responsive to what's up on the screen?
Well, I feel rude coming in midway conversation and presume that anything that I might have offered hasn't already been covered. But since you offered me the chance, I'll be rude. So earlier it was pointed out, and in Pauline's presentation, I thought a fairly small segment of types of lenders was presented, and of course it's quite a broad range of them, and it's also been pointed out the limitations that banks have as a occupational hazard. I think of everything through the lens of technology, and I think technology actually can help really dramatically in making banks make more affordable small business loans possible, and I'd like to see banks explore those options more, and those of us who are working with banks help them see those options more. I have a dog in the race, so I won't mention it, but there are many others like it. And along the lines of financial literacy, it's indeed been pointed out that, and I think part of why it's exciting that the Bureau is looking at small business lending is that this is, it's basically consumers buying small business credit. And the array of credit products available to businesses is staggeringly broader than is the array of consumer credit options. So, right, like now suddenly you have an SBA loan that might work, or receivables financing, or cash flow financing, or factoring. None of those are available in kind of a normal consumer offering. And so, one of the things that we've seen in online lending is that the conversion rate is exceptionally low. And so, to me, what that means is that, someone's buying an online ad, you're coming to them, and they have no idea what it is they're coming to. It just says small business loans, and chances are it's not a good loan fit for you. So services like the NerdWallets of the world and the Fonderas of the world and others are providing a whole, I think, really valuable capacity for financial education and literacy to connect people with that small business borrowers with a much broader range of products that are available to them that is much less binary than bank or online or CDFI, right? Like it is more like 20 or 25 types of products and helping in that kind of Socratic process of figuring out, what's the best fit for me. Though I think the internet can be a very powerful tool, and there's lots of people who are really chipping away at that in compelling ways.
Thank you.
A clarification
Yeah,
point?
please.
Just to make sure that we understand, your conversion rate is a prospect to the actual closed loan or an approved loan, or it's some other conversion rate that you're...
Conversion from application application commenced to completed. So even before acceptance is in the picture, right? We're in the process of the application. You're both providing information and you're receiving information about what it is you're applying for.
Thank you. Neil, then Seema.
Just some thoughts on data elements and data collection. I don't know if you've had any discussions with the Fed or even bank providers around stress test data in the small business area. One of the reasons I think it's important is small business modeling and stress tests is kind of evolving. It's not the science that it probably will be one day. But I do think that there's an intersection here about credit availability and kind of deeper understanding that, both you and those regulators are probably interested in.
Yeah, maybe I could just ask, maybe be a little bit more specific, given stress test tends to be the larger financial institutions.
Yeah, but I'm just suggesting
on
that the insights that you might get from data modelers, even inside a large bank,
Sure.
Could give you some insight in terms of what would be useful data that would allow you to get a little bit more granular in terms of understanding the profiling and the risk profiling of small business, as well as that could lead to a deeper understanding of the design of product and the design of solutions.
Okay, thank you.
Hi, just quickly, just on the piece of revenues versus the income statements, I guess one thing I just wanted to share is that in order for businesses to be eligible for VITA assistance, they use the what is the term I'm looking for? Essentially the profit and loss statement, and that keeps a lot of small businesses out of that. Out of accessing those services. So I think looking at revenues versus those statements is important. The other is, of course, I need to raise the issue of not only collecting race and ethnicity data, but making sure it's disaggregated. We pushed on this with the HMDA data, but even the data that we saw today, when it looks at Asian Americans, it looks at it in the aggregate, and so that means that we have a lot of income diversity within our community, and so that kind of keeps a lot of people out of accessing credit. One example is the Department of Treasury CDFIs. The Asian American and Pacific Islander community is not considered a priority community because in aggregate the income looks pretty high, and so that keeps a lot of these important businesses from being able to access CDFI loans. Last piece are the issues of development interest pushing out small businesses in our cities. I don't know whether it means collecting different types of data or whether you can think about how to collect the data in a way that it can be overlaid with rental costs, because I think it would be really interesting to be able to see if businesses are looking to access credit in order to meet rising rental costs, because it's becoming a major issue in all of our cities.
Thank you. Josh?
This comment was initially related to the discussion with Paulina, but I think ties into this, that in looking at, it's around the online lenders, and in looking at the results that Paulina was showing from that Opportunity Fund study about the alarmingly high APR of many of these online business loans and how there seemed to be a racial and ethnic impact there. There's a concern, I think, about a regulatory void there, and who is going to have jurisdiction in regulating those lenders. Certainly, until there are viable alternatives, people are going to be small business owners, especially ones who are struggling, are going to be pushed towards that option. And it seems like it may fall to the states to regulate, and so maybe there's a role for the CFPB in delving into all of this small business data collecting to start to organize some thinking around how to regulate that industry. And I guess the question that's related is what do you see as the challenges in gathering data on existing online small business lending?
One of the challenges, it's as opposed to the prudentially regulated institutions, is it's hard to even get the list of them. One of the things we're starting to work on is contacting individual states where they might be licensed, but there is not a central depository where we can find them all. There are some trade associations we're in contact with, but you can put together a website and become a lender.
So I don't think we've used maybe we have said complaint database in the last couple of days. And, we as an organization and working with other coalitions have spent a lot of time on the complaint database. And what's interesting is throughout the last 2 days and even before, we hear, so this is what we're seeing. So, and I'm not going to try and pretend what the regulatory or other obstacles are. But if I'm a sole proprietor and I've just opened my tea bar in Rochester, which actually someone I know, and I end up trapped in some online hell, right? Is there any way that we could be getting the word out to folks? And I don't know what would have to happen in the database and what new field would have to be added, or maybe it would just be captured in the narrative and that's fine, so that nobody has to change the fields. I started this business, this is where I am, and I was going to do X, and Y happened, and starting to just, because, to me, to have that complaint database and to be doing what you're doing, especially now that you've even extended the RFI, and not having that, that's such an amazingly rich resource. And I don't know whether Director Cordray can just wave his magic wand and make it happen, or what other obstacles there are. But, I really did not understand how many businesses are just, could be me tomorrow having to open my shingle as a lawyer and needing money. So I would love us to think about that. And the other thing that I think we have to, and maybe if this has happened in past CABs, because this is my first year, financial capability, financial literacy, doing it in a way that's, we have wider sites. We have 13,000 people that come through our wider sites every year. We're like one of the best in the country. And we have this little coach program, but it's so high touch. We touch virtually no one. And with all the fancy technical people in the room, why can't we figure out a way where we whether it's for just someone, not necessarily a business lender, but especially a business lender, because it's so cost prohibitive, as we know from technical assistance, and how much it costs and how little we can do. We have that in Rochester, but we touch hardly anyone. It would be so amazing, and if we could gather in the survey how much need there is for TA. So I'm making more work for all of you, but it's the end of the session, and I'm going to stop talking now.
Oh, if you could hit your mic button for a sec. Oh, thanks, Ann. Maybe drilling down some more on what the existing barriers are to getting a small loan. I'd like to understand more about what the reasons were for denial. Are there typical profiles of a person who was denied? Is it because there is insufficient capital? And then segmenting probably by amount of loan, but maybe you'll see other kinds of patterns depending on type of business. And it seems as if there are some maybe trends in lending that that are over and above what you'll see on this borrower side. That maybe industry as a whole, except for CDFIs, has decided that really credit card. If you need up to $20,000, it should be a credit card. So who is getting a $20,000 loan from a bank or a credit union for up to $20,000 right now? What do they look like? And I don't know if there are typical profiles that could be drawn from the financial institutions. And then but understanding more about why people are denied. Lack of collateral, the collateral requirements, I assume, get much more extensive when you're, asking for $50,000 or more. I'm kind of more concerned about the lower end, because when we have clients, the examples are more like, I need $5,000 to get my truck repaired and to pay the guy who helps me out sometime. It's my business, but I have a guy who helps me out sometime. Or I need materials, and I can't do this job that I've promised to do unless I get $5,000 for my materials. Yeah, leave it at that.
So one of the questions in the RFI goes to the challenges that are faced by small business owners, including or applicants, small business owner applicants, including minority-owned and women-owned. So that is an area that we are very interested in hearing about, and in a way, it ties back a little bit to your comment in terms of it. In terms of the complaint database. And there, what I was thinking about, I worked on the HMDA final rule, the proposed rule and the final rule, and in receiving feedback throughout that long process, both in individual one-on-one meetings that we would have with both industry and community groups, and then through the comment period for the proposed rule, and then after the proposed rule leading up till the very end for the final rule, we did get a lot of very helpful, what we call sometimes testimonials, stories of what actual consumers are facing. So I would encourage you to think about ways to get us information. If it's not submitted in the consumer within the in the complaint database as part of the narrative, again, I would just encourage you to think of ways to get us information that really can get to that question. It came up yesterday, Judith, in our breakout session when you were talking about the folks that you work with. Again, I would encourage that, because that's very helpful information for us.
Thank you. Other feedback for our small business lending team, Tim?
Yeah, so I was thinking a bit more about how to classify collateral. I mean, if you think about it, most business loans are based on either receivables, equipment financing, or some other kind of collateralized line, right? I think that's critically important when you're assessing fair lending, because, for example, if I'm an Uber driver and some company has given me a loan to buy a car, that should be compared to other similarly collateralized loan classes by race, sex, and ethnicity, right? And, if it's an accounts receivable line for a dialysis clinic, that should also be considered that way relative to, say, an accounts receivable line for a much more volatile business, like, say, someone selling flowers. So I think business type and type of collateral is critical.
So that seems to get, so that's a business, when I think about business sources for data, this is the underwriting guidelines from a wide variety of providers. Their underwriting guidelines to the extent, obviously, that they're willing, I know it's you've already thought about that, but I'm thinking about wondering how much they'd be willing to provide, which would be really helpful and would answer some of your points. Because they should be evaluating vulnerability by sector, cash flow, all these other elements, and I think Ariane had also mentioned some of these elements as well, just basic underwriting, things you would like to see done. Other comments?
You've probably thought of this already, but just in case, I mean, folks here mentioned low-income tax clinics and Vita sites. The IRS itself might be a rich source of data. You know, there's all this data on Schedule C. For folks who think of themselves as self-employed but are really small businesses, and they've got an entire office of statistics, so they might have some. And sometimes with them, it's a matter of getting them to put it on their list of tasks and moving it up. So if you ask them, maybe they'll be willing.
My reaction when you said that was you can't get it from them, but when you say that they have an Office of Statistics, I'm not even aware of that. Maybe they do. Is there aggregate data that they are able to provide that might be of any use to us?
They do have some aggregated data based on tax form classes. So, for example, they would be able to tell us how many people file with a particular type of return, those sorts of things.
Are we gonna dig through that?
It's on the list. But we will.
It's a very, very long,
Yeah, exactly
long. I do
right.
not envy you your list. Ariane?
Just briefly, and this is one of these topics that interacts with another one around the aggregators. And of course, the aggregators, the Yodleys and Plaids and Finicities of the world are relevant to consumer finance. But it is in business lending that has really, where the practice has already been put into place of using those cash flow data for underwriting purposes, and it's far ahead of what they're doing in consumer finance. And so to the degree to which you're not aware of that, you should be, and I imagine there's a lot of data to mine there.
Another thought, miscellaneous thought, I don't know whether Social Security codes any of the information that comes through in a way that is exportable, can be reviewed. I'm wondering whether they code sources of income when they're tracking income, since they're tracking income for purposes of retirement. I'm just trying to be creative here. But it occurred to me when we were talking about the IRS and I hadn't thought about Social Security before as a possible sort of source of data. But Jim.
You know, I almost forgot about something that I used to use a lot to get some real surprising and insightful data on what you're actually referring to, which is the micro business. You know, that there's so many of them. They're so unique from even a classic, small business, even below the SBA massive category. And so, a technique I used to use would be to take the many consumer surveys that are available from a lot of companies, going back many years and hopefully comparable, and then cross-tab them by people who, and these two categories are really important. They serve different purposes, so they're each important in their own right. One, people who say they're a small business owner, so that has value, self-reported, of course. But then especially then looking at people who say they actually have a business bank account or other business product. And so I know there are companies out there that have this data because my former one did, so I'm sure there are others. But when you get to those, so you get different levels of growth, but the great majority of those always will be those important micro businesses. And what's really interesting about that data is that you start to look at financial picture of small business owners from the standpoint of their finances that are really liquid between their personal financial situation and the business's financial situation. And you run into some challenges, but some opportunities, and those monies move back and forth, which is what gives some creativity and some risk to these people. So I would urge you to look at that kind of data.
Other thoughts, folks? I had one notion for you all when I looked at a different question about selecting where do you start in this giant universe of 26 million people potentially, and I'm wondering whether I'm thinking sort of the hourglass. It's either or, either people who experience a lot of income fluctuation over the course of the year and are likely to be in businesses where there is that fluctuation and therefore they would need access to credit. That would also arguably lead to them being part of the block of folks who receive denials more commonly. So in some ways the need is great, but also perhaps one might think that they're less likely to really be able to qualify. So I think about the analysis, some of the analysis Amex did in U.S. Financial Diaries on income fluctuation, and I don't believe that I'm not sure whether they actually dug in and tried to do any sort of data analysis about whether it is gardeners, caregivers, nurses, who experiences the most income fluctuation, seasonal workers. Some of that data is probably already better collected, maybe by the folks who manage the NICS list, but maybe that's one way to sort of try to begin to decide, okay, if we're going to do this, also focus on particular blocks of people, which piece of that universe of 26 million do we start with? Whom do the folks whom we think are most likely to receive a credit denial, or folks who are most likely not to think of themselves as a small business? But just trying to toss out an idea for maybe how to segment the gigantic task that you're undertaking. That makes sense.
I mean, your point would be one of suggesting that industry might be very important. So, for example, you wouldn't compare a restaurant with a physician's office, those sorts of things.
And cash flow is just going to look different in different industries. And so where's the greatest area of need? Who is it who's most likely to have the need for access to credit? Maybe the physician's office, maybe not. Maybe not an industry that's likely to get paid out of insurance, or and I would need to give more thought to how to decide which to select first.
If I could just offer an observation, because your comment and many others kind of underscore a dilemma that we had. We had it with the white paper that we did. And the old economist joke, assume you have the can opener when you're on a desert island. It would be lovely if we had the data to actually dive in these ways. And so we're really at the stage where we're trying to think about the trade-offs of the cost of the data and how you get it and how readily available it is to those questions you'd like to be able to answer at the end of the day when you have the data, when you have the can opener. So the more you can help us think, Rui, your comments about how you're using currently that data and looking at the possibilities and what would the data elements that Congress specified versus that one or two others that might be insightful. Why I asked you, are there proxies that get at that difficult issue of sophistication and how important it is to be able to think about a database that could tease those things out? That's how you could really be helpful to us in helping us to make those kind of trade-offs and helping us to get the folks who are actually going to have to collect the data and report it to us thinking about the right ways to look at the cost and benefit trade-offs that we're going to have.
And actually, Grady, if I could respond to that, and now that I thought I heard that the RFI was extended by 60 days, but I think you just repeated that. So we're kind of really fortunate with some of our lenders in Rochester, where again we work with them over a long time, and we just sit down and we just brainstorm the way I would with another community advocate, and I'm really fortunate in being able to do that. but I do have those kinds of relationships, and I just say, okay, let's forget everything. We're in a room. This is totally off the record. You don't have to. I'm not going to repeat this to any of the regulators. And I've actually had some very good conversations around mortgage lending. And I just literally, as you said this, I was like, oh, I can do this for small business lending as well. And I promise you I will do that.
Neil?
Yeah, Grady, interesting insight. So I wonder, so 1071 is about equal credit opportunity for small businesses, making sure that minority communities, low moderate income communities are equally or not disadvantaged, right? I don't think that, which is, I think, good, okay? However, to your point, I'm not sure that the outcome of that is going to actually improve credit availability in low moderate income communities. And I think that did you see that as the dilemma here? Because even as you listen to a lot of the comments and input, most of us are talking about making credit available, not making it only fair. And I think that getting clear about the outcome here is going to allow you to design the data requests in a way that will actually serve whatever outcome you're looking for. And I don't know who in Congress decided those were the elements, but they weren't somebody that I think was looking at this as an outcome of improving the credit availability in these communities.
I think to that point, there are two purposes that are stated in the Act. There is the credit, ECOA credit access via the Act, but there's also community development rationale that is part of the justification there as well. And I think part of that issue of where there are credit deserts, where there may be gaps, holes in the donut, if you will, where you see an area that, in the HMDA world we've called it redlining for years. I think these data will be helpful in helping to identify that. I think to the extent that we can think about things that can then, if you see something like that and you see a disparate pattern, for example, of approvals in that donut, if you will, for the activity that may or may not be there, and those outside of it that relate to some of the issues that you've been talking about in terms of financial literacy, sophistication, all of that kind of thing. Those are the kinds of things that might point to policy alternatives or options that might be helpful.
I see that, okay, but if you think about equal credit opportunity for individuals, okay, you can live with 6 or 7 to 1 disparities and be happy with that, I guess, right? But that has nothing to do with a credit desert. So I guess what I'm just suggesting is that do you think that, so I think the example that Maeva gave earlier, what we find is that you've got concentrations of small businesses in low and moderate income communities that are not credit able because they have no capital or they're a profile that just makes it too risky to lend. So then what happens?
So I think that really, Neil, I think that really gets back to what are the critical data elements that would need to be included in order to do a proper assessment of the statutory purpose of this section. So you pointed out that from your perspective, you don't think the elements that Congress gave us are the right ones. So from what we would want to know is, well, what are the right ones? And not necessarily 40, if you could prioritize, really emphasize in the work that you've been doing, what are the critical missing pieces to that picture? For example, we often say that HMDA has been around for over 40 years. It took a while for it to get to where it is now. From our perspective, looking at this project, what are the key elements that you would need, that you think we would need as well, to fulfill the statutory purpose? I've heard a few mentioned already: collateral, very important, personal guarantees, number of employees, perhaps. You mentioned denials and really understanding denials. If you look at the data, there's not, or the statutory data elements, there's not much there in terms of underwriting. So is there something that would be, incredibly helpful to include? So I encourage you to share that information.
Can
We
I answer Neil's
actually we
question?
need to wrap.
Okay.
Sorry.
I will answer your question.
But we can definitely chat afterward. It's a great discussion, tremendously important work. We're all engaged in what the Bureau's doing around this issue and recognize that, especially from the data that you've provided, that this is an even bigger, harder to dive into issue even than what I would have imagined. I want to thank all of the CAB members for your focus, your energy, your great input, your efforts. I want to thank our presenters, our CAB presenters today, Paulina Gonzalez from CRC, Lynn Drysdale from Legal Aid of Jacksonville, but thank all of you and Bureau staff as well. This concludes our public session. Thank you so much.